Facebook stock is down 15% over the past week. Should you be buying more shares now? Hey everyone, welcome back to FiscalVoyage. My name is Felix, and in this video we're going to do a stock analysis on Facebook stock and determine if at current prices if it's a good buy right now. But before we get started, if you're new to the channel, make sure to hit that subscribe button and like this video, as well as check out my free ebook in the description below. It's 5 quick metrics to look for before you spend more time in evaluating any specific company. So let's get started with the stock analysis on Facebook. All right, let's get started with the Facebook stock analysis. Ticker symbol FB. I'm sure you guys know of Facebook. They make most of their money in marketing, doing ads that you guys probably see on your Facebook feeds. But let's look at the fundamentals for Facebook, which has been outstanding. Revenue grew at 48.8% annually, compounded annually rate from 2010 to 2019. Net income at 46% for that same time period. Currently, there isn't a S&P credit rating, but based on the balance sheet, which we'll look at later, is definitely A+. Operating income at 41.8%. growth in that 10-year period, as well as earnings growth at 42.8%. This was in this last 8 years period. And the best part is the past 5 years, revenue has been growing at 40.9%. So it is dropped over the 10-year average, but still a tremendous amount of revenue growth at 40.9%. So that's tremendous. Net income as well, it actually increased from 46% for the 10-year period to 49% for the past 5-year average. And earnings past 5-year average has dropped from 42% for the 8-year period to now 29% for the past 5 years, but still tremendous growth for Facebook, as you see there. Fundamentals, let's continue here. 2019, the company earned $6.43. Net margin came in at a nice 26% rate. The net margin is lower than the 2018 where they had 39% net margin. But their trailing 12 months has increased to 31.3%. So net margin is expanding versus 2019's for the past 12 months. So that's very positive there. Return on equity for the past 5 years average around 20.3%, which is positive there. And this is very attractive here. Price to sales, which is your price to the revenue based on outstanding shares, is at 10.9 versus a 5-year average of 12.6. So that's very positive there. That's meaning it's a good indicator that it might be undervalued. So we'll look at this later in the final slide where my fair price comes up. PEG ratio is also lower versus the 5-year average. You like to see this especially for growth company 1 and lower. You see here at 0.96 ratio versus a 5-year PEG ratio of 0.99. So that's a positive there. The PEG is lower than your 5-year average, as well as enterprise value over earnings before interest, tax, deductions, and amortization. You see here it came in at 20.1 versus a 5-year average of 23.4. So that's another good indicator that the company is undervalued based on these fundamentals. And now let's look at the Facebook outstanding balance sheet. As you can see here, debt to cap is only at 8%, so that's very, very low. That's very great. Current ratio is great at 6 ratio. You like to see this at a very minimum 1.5 or higher. The higher it is, the better. So that's a great ratio there. Debt to equity, like I said, the debt to cap is at 8%. Debt to equity at 0.1 ratio. So that's outstanding. So they basically have no debt. Interest coverage is not available. I couldn't find that information. But based on the debt to equity ratio and debt to cap is very low, as well as the current ratio very high there. So that's very positive. Price to book currently at 6.8. It is higher than the 5-year average of 6.6, but very right there, fairly placed there. So let's look at the future outlook for Facebook. 2020, analysts are expecting earnings to be at $8.07. It is higher than 2019 earnings of $6.43. And considering a lot of companies stopped their advertising because of the shutdown and stuff, that's very positive news there actually. Because of the the shutdown, not a lot of companies were pushing ads out because who's going to be buying where stuff are closed? I can't go shopping or stuff unless online, obviously. There were still ads. but not as much as prior years. And the fact that their earnings is going to be higher for 2020 than 2019, that's very positive news. 2021 is expected to be even higher at $10.31. CFRA is projecting a earnings growth of 19% for the next 3 years, which I think is quite high. I think about a 14 to 15% annual growth rate for earnings is very conservative and more what I like to see here. Not what I like to see, but I think that's where they're going to be lined up with. But who knows? 19% is very good. Using the dividend drill return model, I came up with 15.4%. Obviously, they don't have a dividend, so I put a 0 for that field, and it still managed to come up with 15.4% annual rate of return, which is very good. Nice double-digit rate of return there. PE for growth company, you look at PE, but sometimes they don't matter. But for this company, Facebook, forward PE at 32.8, which is a lot lower than the 5-year PE average of 43.4. And they currently have a PE of 34.7. And the forward PE is lower because of the higher earnings expected for 2020. So that's very positive there. So let's look at the fast graph for Facebook stock. For Facebook, as you can see here, the growth for adjusted earnings has been tremendous. 66% in 2013, 101% in 2014, 30% in 2015, and 86% in 2016. So it's been tremendous. This year, however, or in 2019, it dropped by 15% from 757 to 643, but it's expected to pick up right up in 2020 with 26% growth and 28% and 21% going forward. So you can see here, this basically earnings growth does come in with this, so this is why we're going to use a shorter time frame. As you can see here, it doesn't look as good, but even at current prices as $263, which is based on yesterday's closing price, you can still have a nice annual rate of return, about 9.5%. So that even though if it goes lower, or at current prices, still a nice rate of return here. And if we shorten this even closer, you can see here this is more reasonable because it affected the prior year, down in earnings for 2019. So we get rid of that. You can see here almost 20% annual rate of return growth at current prices. That's with a PE of about 34. And you saw, currently the price to sales is a good ratio versus a 5-year average. The revenue growth, net income growth is also tremendous. So this is definitely feasible. And if we look at the forecasting here, you can see here, even with a PE of 29, which is much lower than their current PE, you still have a rate of return of about 16.33 for the next 2 to 3 years. So that's still a very nice rate of return. This actually goes more with the dividend discount drill model there. But the fact that the company, analysts are expecting 24% growth, for a foreseeable future, that's tremendous. And there's 49 different analysts looking into this company. So I'm very confident with these estimates. Another thing to look at when evaluating growth stock is the operating cash flow. As you can see here, operating cash flow has been tremendous as well, going over 30% growth rate, 83% in 2016. Last year they grew it at 26%. This year is going to be flat or down by -1%, but picking right up in 2021 and 2022. If we shorten this time period to, let's see here, 4 years, you can see here, normally the company looks like it likes to value it at a 14.7 price to operating cash flow, and right now it's at 21, so it is high based on this, but still the fact that the company is growing very nicely, this looks like a good buying opportunity. And if it does go lower, up to $225, it's basically buy it all the way down, really. But the reason why this looks kind of overvalued is because they're flat from year over year for 2019 to 2020 in operating cash flow. But if this was because of the economic shutdown and all the things that's going on, and less company are spending money on ads, this is why it affected it. But overall, it's still positive. as you can see here, is expected to pick up very nicely. And I think by December of this year, a lot more companies are going to be spending on ads, and for the next year or two, because they will imagine trying to catch up with the revenue loss during this time period. All right, so here's the fair value prices that I came up with and other analysts came up with as well. CFRA at $370.35, which is the higher out of the four. Morningstar at $265. FastGraph, as you saw, $270, and this is based on 2021 expected earnings. And then Yahoo, $287. My dividend discount model analysis, and they don't have a dividend, so I couldn't calculate that. But averaging out to 4, we get a fair price of $298.09. Currently, the company going for $260, and it's down today, so that's very good news. That means the company is undervalued by 14.6%. And this is why I have Facebook stock as a buy recommendation at current prices. So there you have it. I have Facebook as a buy at current prices. The revenue growth, the net income growth, the earnings growth is all tremendous. The balance sheet is outstanding. Is it possible that the stock could get lower? Absolutely. But right now it presents a good buying opportunity. And if it does get lower, if it drops 10%, 15%, buy more shares, because Facebook is a long-term play here. Everyone uses it, and a lot of my company uses it as well to promote their products and services. So I hope you enjoyed this video. And again, if you're new to the channel, make sure to hit that subscribe button and like this video as well to help with the YouTube algorithm. And make sure to check out my free ebook, and I'll see you guys in the next one.